What just happened to silver? Again? We saw another brutal 3% drop on February 15th, pushing prices down to around 77 per ounce. And if you've been following this market, you know this isn't the first time we've seen silver get absolutely hammered in 2026. Just a few weeks ago, silver was touching historic highs above $110, and now we're watching it struggle to hold above $75. So the big question everyone's asking is this a buying opportunity, or is this the start of something much worse? In today's video, we're going to break down exactly what's causing these massive price swings, analyze the Federal Reserve's role in this chaos, and identify the critical support levels you need to watch. Let's dive in. The crash breakdown, 0.30 to 30. All right, let's talk about what we're seeing right now. On February 15th, 2026, silver dropped approximately 3%, bringing spot prices down to the $75.45 to $77 range, depending on which exchange you're looking at. Now, to understand how significant this is, we need context. In late January, silver hit an all-time high above $111 per ounce. Some sources reported it reached as high as $121 on January 29th before the collapse began. That means from peak to where we are now, we're looking at a decline of roughly 30 to 35%. That's not a correction. That's a market getting absolutely crushed. But here's what's interesting. This isn't panic selling from retail investors alone. What we witnessed in late January was what many analysts are calling a historic liquidation event. The Chicago Mercantile Exchange raised margin requirements dramatically. For silver, they went from 11% to 15%. When that happens, highly leveraged speculators get margin calls, and they have two choices: deposit massive amounts of additional capital or liquidate their positions immediately. And guess what happened? Mass liquidation. Treasury Secretary Scott Bessent even commented that the extreme volatility was driven by speculative activity, particularly from Chinese traders who had been piling into silver during the massive 2025 rally. So yes, we dropped 3% on February 15th, but this is actually part of a larger unwind that's been happening since late January. The market is still trying to find equilibrium after shaking out all that speculative froth. The Fed impact, 230 per 5. Now let's talk about the elephant in the room, the Federal Reserve. Because if you're wondering why silver can't seem to catch a bid, the Fed's recent actions are a huge part of the story. On January 28, 2026, the Federal Reserve held interest rates steady at 3.5% to 3.75%. This wasn't surprising. Most analysts expected it. But what matters is the signal it sends. The Fed essentially said, we're pausing our rate cutting cycle. They'd already cut rates by 175 basis points since September 2024, bringing us down from much higher levels. But now, they're hitting the brakes. Why does this matter for silver? Silver is what we call a non-yielding asset. It doesn't pay dividends or interest. When the Fed keeps rates higher for longer, suddenly yields on treasury bonds, money market funds, and savings accounts become more attractive compared to holding silver. Capital flows toward where it can earn a return. But there's more to the story. Markets are now pricing in only about 60 basis points of Fed easing for all of 2026. That's less than 3/4 point cuts. And with the strong employment report we got on February 11th, traders are starting to question whether we'll even see those cuts. When that jobs report came out, Treasury yields spiked and silver got hit hard. Plus, there's political uncertainty. President Trump announced Kevin Warsh as his pick to replace Jerome Powell as Fed chair when Powell's term ends in May. Now, Warsh has historically leaned hawkish on monetary policy, meaning he tends to favor higher rates to combat inflation. The market doesn't like uncertainty, and a potential shift in Fed leadership adds another layer of unpredictability. Here's the takeaway. The Fed isn't your friend if you're bullish on silver right now. Higher for longer interest rates create a headwind. Every data point that suggests inflation is sticky or the economy is resilient pushes rate cuts further into the future, and that pressure compounds on precious metals. Technical analysis and support levels, 5 or 730. Let's get into the technicals because this is where things get really interesting. If you're trying to figure out whether to buy this dip or protect your capital, understanding support and resistance levels is crucial. Right now, silver is trading in the 75 to 77 range. The immediate question is, where does it go from here? According to multiple technical analysts, the key support zone to watch is between $69 and $75 per ounce. This range has been identified by several major forecasting firms as a critical floor. If silver can hold above $70, there's a reasonable case that we found a bottom, at least temporarily. Let's break down these levels. First support, $75, $76. This is where we are now. Some analysts point to $76.45 as an important Fibonacci retracement level. If we hold here, it suggests buyers are stepping in. Second support, $70 to $71. This is a major psychological level. Multiple sources cite $69 to $70 as a strong support zone. This is roughly where silver bounced before in early February after the initial crash. If we break below $70, that's when things get concerning. Critical support, 65, 69. If we fall through $70, the next major support cluster sits in the mid to upper 60s. Some technical charts show $65 as a key level that coincides with the 200-day moving average. Worst case, $60. Below $65, analysts warn that a move to $60 is possible if the bearish momentum accelerates. However, long-term bulls argue this would represent an extreme oversold condition and a major buying opportunity. On the resistance side, if silver rallies, here's what we're looking at. First resistance, 82.84. This was the level where silver got rejected multiple times in recent weeks. Breaking above $84 would be the first sign that bulls are regaining control. Major resistance, 87.90. If we can clear the low 80s, the next target zone is the high 80s, where previous consolidation occurred.